Hi, this is Dan with Invest Rent to Own. Thanks for watching me today. Today we're going to talk about opportunity zones and qualified opportunity funds. These were something that was added just a few years ago, and I think it's worthy of a conversation. So let's talk, let me give you a little bit of an overview here. My goal is to ultimately teach you, give you a little bit of understanding of what opportunity zones are. So we'll start with what is an opportunity zone and the benefits of what an opportunity zones present for a real estate investor. Then how to set up a qualified opportunity fund, and ultimately the potential strategies that you could use to take advantage of the QOF, which is a qualified opportunity fund. All right, let's get into it. What is an opportunity zone? Opportunity zones were created through Congress in the Tax Cuts and Jobs Act of 2017. Essentially, what it did is a bunch of politicians got together and said, hey, if we offer some tax incentives to people that invest in underdeveloped or areas that we'd like some focus on, we might see more investment and development in those areas. And so they got with local leaders and asked them to carve out, their local downtowns or wherever they felt like they needed good development, and they fed that back. And so ultimately you got this list that is published through the Housing Urban Development. You see the link there, opportunityzones.hud.gov. And you can go there and you can search for where opportunity zones are in the areas that you're investing in. So essentially, if a house is within an opportunity zone, within the boundaries, then you could potentially get this benefit. Or if they're not, then you don't. Well, what are the benefits of an opportunity zone, qualified opportunity zone? That's QOZ there. They allow you to defer tax on eligible gains when you invest in a qualified opportunity fund. So I'll get into that in a little bit, but the big benefit is essentially you can defer capital gains. Okay, and they are not just gains of real estate, it could also be gains of stock. So if you had a stock that you held and it rose up a lot and you don't want to sell it because you don't want to pay the capital gains, this gives you the opportunity to sell it, invest in a qualified opportunity fund within 180 days, and defer those gains potentially forever. So it's a huge deal for bigger investors. Might be an important thing for you if you've had some of your capital parked in stocks for a while. You also can defer these gains on 1231 gains. Now, I'm not an accountant, and so I don't have this perfectly right, but my understanding of what 1231 gains are is they're kind of like passive gains, or they're depreciated property that would have some kind of depreciation recap to it. I'd get with your CPA if you really want, or do some more searching about what 1231 gains are to see if the particular gain you're thinking about deferring would apply for this. So ultimately, the tax on this gain of the thing that you sold in order to invest the money into this qualified opportunity fund, the tax on that is deferred. And potentially you could roll it further. I don't know this for sure, but to me this makes sense. I haven't done it yet. You can roll it further with 1031 exchanges. This deferral is good until December 31st, 2026, or when you sell the investment, whichever comes. So, how do you set up a qualified opportunity fund? Well, it's not very hard. Ultimately, you have to set up an LLC or have an LLC. I suppose you could repurpose one. You'll see there's some other restrictions. You then elect to be a QOF by filing an IRS Form 8896. So you do that on the first year that you want to take this filing status, and every year thereafter, but the first year is key. You then purchase properties within qualified opportunity zones. And you maintain that at least 90% of the assets owned within that QOF are invested in qualified opportunity zones. So this gets a little bit tricky because 90% is actually a lot when you consider the balance of cash that you have available to invest and the invested amount. So if you raise $1 million, for example, you've got to have within a specified period of time, I want to say 180 days, 90% of those assets invested. So that might take a little bit of time. Maybe it's just one big property. Maybe it's a multifamily property that you want to buy and you can dump it all in at once. But also maybe it's something that needs a little bit of development and that takes some time. I have seen that it looks like that you do some reporting of what your assets are month by month over time. Again, something your CPA would likely help you out to maintain your QOF. And even if you're not 90% invested, you still get benefits. And that's what that reporting is all about. So some things to think about is you could potentially fund it with your own funds, or perhaps you could set up your own investment fund for other investors to defer their gains in your qualified opportunity fund. So you do that by, how would you benefit from that? Great. Well, they're benefiting because they're getting a deferred gain. They'll get benefits from the from the investments that you make, some cash flows, some capital gains. However you decide to set up the LLC, that's how you might benefit. So maybe you get a 10% off the top, or maybe you get a guaranteed payment over time. However you decide that to do it and offer to other investors. So some potential strategies that you might consider using this new way of investing. Perhaps you've got some personal stock gains that you would like to apply to real estate, but you don't want to take the capital gains on them because you can't do a 1031 exchange from stocks to real estate. So now you can. Now you can take that stock gain and now plow it into real estate in these particular areas. You could also advertise and raise money based off of other investors' gains for your setup QOF. There's also a potential for a step up in basis to reduce your taxes. Step up in basis essentially could write off entirely the tax gain. My understanding is that you really had to have started, this idea came a few years ago, 2017, and you have to be invested in the property for a length of 7 or even 10 years. If you're invested and hold it for 10 years, then essentially your tax gain is wiped off entirely. But the fact that it started in 2017 and now we're in 2022, that is less of a benefit. However, I think as they review what the good things have accomplished in this, you might see Congress again take up this idea of QOF, of qualified opportunity zones, and extend that even further when they realize how these downtown areas are being revitalized and how that's really just a good thing for all areas of the United States in general. So there you go. There's a little bit of a primer on quality opportunity zones and qualified opportunity funds and how you might use them to benefit. Again, this is Dan with Invest, Rent to Own. If you like this, I appreciate it if you give me a thumbs up and subscribe to my channel. And we'll talk again soon.